Hello and welcome to our video exploring in detail shareholder and partnership protection planning. This video includes why you might want to consider this in your business, the tax treatment and benefits, including the specific components you'll need to think about when arranging any policy. This video is brought to you by industry experts Financial Fortress Ltd, independent financial advisors. Shareholder protection, partnership protection for non-limited companies. First of all, what is it? Simply put, it's a cost-effective way for the owners of a business to secure their succession plans in the event of their death or illness. It ensures that the future ownership of any business ends up in the correct hands should your circumstances take a turn for the worst. So why is shareholder or partnership protection so important? When someone dies, their property, including any shares in a company or proceeds from a partnership, becomes the property of their estate. In reality, this usually means the deceased's family members, perhaps their spouse or children, for example. This means their assets, control and profits of the business, including future profits that may be due, passes away from the original owners and any surviving shareholders or partners to the deceased's family. So let's think about this. How would you feel paying profits forever to your ex-business associate's family, especially where they are now not contributing to the running of the business itself? And how would you feel if your ex-business associate's family wanted to get involved in running the business and making decisions, given they may have no experience of running the actual business itself? So how is shareholder protection set up? There are a number of steps in the process to ensure any plans made are effective, and they can be described as: each owner, i.e. partner or shareholder, affects a life insurance policy on their own lives for an amount equal to their share value, i.e. their valuation of the business that they will ultimately give away if they died. Each policy is then placed into something called a trust, in benefit for the fellow business owners. This means their fellow business owners would receive the proceeds of the life policy in the event of their death. The future deal is then underpinned by something called a cross-option agreement, and this then ensures the proceeds of the policy passes from the business owners to the family, and the corresponding shares or business assets pass back from the family to the remaining surviving business owners. You should also consider equalising the premiums, and this means that each shareholder or partner pays an equivalent share of the cost of the policies, given the share they would ultimately receive. So having set up a correct arrangement, in the event of either business owner's death, the following will now happen. The deceased's estate continues to inherit the shares of the business. However, the remaining shareholders, business owners or partners receive the proceeds from the life policy itself. The cross-option agreement can then be exercised by either side, and when exercised becomes binding on the other party, meaning the cash passes from the remaining business owners to the beneficiaries for their shares. Now this is a really important element because any compulsion that's built in, i.e. if any of the parties are bound to exercise the agreement, then it's potentially taxable for inheritance tax. But because there's no binding agreement in place, it generally excludes inheritance tax. Basically, this then ensures that the business is effectively owned and the family is compensated appropriately for their loss. Here are some key facts and benefits. There's no tax relief available on the premiums, and where the company pays for the policies, the premium should be charged to the individual owner's P11D. That's taxable as a benefit in kind. Any policy proceeds will then pay out completely free of tax. There will be no tax to the beneficiaries, including no income tax, no capital gains tax, and no inheritance tax, assuming it's been set up correctly. The trust element means there is a rapid payout on death or illness. Flexible beneficiaries. Therefore, if new business owners join in the future, the plans can be altered rather than having to completely restart the planning again. It does, however, need a regular review for business valuation purposes due to the ever-changing value. For example, your business could be worth £100,000 today, whereas with business growth, it could be worth considerably more in the future. As always, with anything complicated, good financial planning is absolutely key, and at Financial Fortress we have the dedicated experts in this field. We will make sure that your plans are set up correctly using the correct policy, trust and agreements. Being independent and whole-of-market advisors, we will recommend the most cost-effective policy for your needs, and we will ensure all plans are arranged to maximise tax benefits to both individuals and the business itself. If you want to get in touch, please do, and we offer all prospective clients a free and no obligation review, including the provision of accurate quotations where needed. And we can be contacted by the phone 01244 319962. You can email us at info@financialfortress.co.uk or visit the website that we've given the information on screen. Thanks for watching.